In the world of cryptocurrency, everyone seems to have an opinion. Some people believe it's the future of finance, while others see it as little more than speculation. Yet every market cycle produces investors who dramatically outperform the average participant, not because they get lucky, but because they follow a clear strategy and stick to it. The portfolio you build, how you allocate your money, and how you manage risk often matter far more than finding the next viral coin. Today we will talk about the exact crypto portfolio that changed everything. Don't lie. So before we get started, make sure to hit that like button, also subscribe to my channel. 10. The portfolio was built around a clear plan. The biggest mistake many new crypto investors make is buying random coins because they see other people making money. They scroll through social media, hear about a token that increased 500%, and invest without understanding what they own. The portfolio that changed everything began with a simple rule. Every investment needed a reason behind it. Before a single dollar was invested, the investor created a plan that defined their risk level, investment timeline, and goals. They understood that entering the crypto market without a strategy was like starting a journey without knowing the destination. A clear plan helped them avoid emotional decisions during both market excitement and painful crashes. 9. A large portion went into established cryptocurrencies. The foundation of the portfolio was not built entirely on risky, unknown projects. A significant portion was placed into more established cryptocurrencies that had longer histories, stronger adoption, larger communities, and more developed ecosystems. This created a balance between growth potential and risk management. While these assets could still experience major price swings, they were generally considered less speculative than many smaller projects. The investor understood that protecting capital was just as important as searching for massive gains, because losing a large portion of money requires an even larger percentage gain just to recover. 8. A smaller portion was dedicated to higher risk opportunities. The possibility of extraordinary returns often comes from smaller projects that are still in the early stages of development. However, these opportunities also carry a much higher chance of failure. Instead of putting the entire portfolio into speculative investments, the investor only allocated a controlled percentage toward high-risk opportunities. This allowed them to benefit if one of these projects experienced significant growth, while limiting the damage if the investment failed completely. The lesson was simple. Taking risks can create rewards, but unmanaged risks can destroy a portfolio. 7. Dollar cost averaging reduced emotional decisions. One of the most powerful strategies used in the portfolio was consistent investing over time. Instead of investing all available money on a single day and hoping it was the perfect moment, the investor regularly added funds to the portfolio. During market declines, those same dollars purchased more cryptocurrency. During market increases, they continued building their position. This strategy, known as dollar cost averaging, reduced the pressure of predicting short-term price movements and created a disciplined investment habit that continued regardless of market emotions. 6. The investor ignored the daily noise. Cryptocurrency markets operate 24 hours a day, and prices can change dramatically within minutes. News headlines, social media opinions, and market predictions constantly influence investor emotions. Many people make the mistake of checking their portfolio every hour and making decisions based on temporary movements. The investor behind this successful portfolio focused on the long-term vision. They understood that short-term volatility was part of the journey and avoided making emotional decisions based on fear during crashes or excitement during rallies. 5. The numbers were reviewed, not the emotions. The phrase "numbers don't lie" represents one of the most important parts of this strategy. Successful investors understand that emotions can create poor decisions. Fear can convince someone to sell at the bottom, and greed can convince someone to buy after a massive price increase. Instead of following emotions, the investor reviewed measurable information such as portfolio allocation, market conditions, project development, personal financial goals, and risk exposure. Decisions were based on facts and a predefined strategy rather than temporary feelings. 4. The portfolio was rebalanced over time. A portfolio that starts balanced will not stay balanced forever. When one cryptocurrency grows much faster than others, it can eventually become too large a percentage of the total portfolio and increase overall risk. The investor regularly reviewed their holdings and adjusted allocations when necessary. Some profits were taken from assets that had grown significantly, and those funds were moved into other opportunities or safer positions. This helped protect gains while maintaining the original investment strategy. 3. They understood that market cycles change everything. One of the biggest lessons learned was that no market moves upward forever. Cryptocurrency has experienced periods of incredible growth, followed by severe declines. Many inexperienced investors believe their success comes entirely from their intelligence during a bull market, only to lose a large portion of their gains when conditions change. The investor studied previous cycles and understood that patience and preparation were essential. They knew when optimism became excessive, risk increased, and protecting capital became just as important as pursuing more gains. 2. The biggest growth came from patience. The most surprising part of many successful crypto stories is that the biggest returns often came from doing very little. After creating a strong portfolio, the investor did not constantly trade every small market movement. They allowed time for the projects they believed in to develop. There were periods when the portfolio was down significantly, and there were moments when selling would have felt easier than continuing to hold. However, patience allowed the investment strategy to play out over the long term. 1. The real secret was discipline. Not a magic coin. Everyone wants to know which cryptocurrency will become the next huge success. They search for the perfect token that will create instant wealth. But the biggest lesson from this portfolio is that long-term success was not created by finding a magical investment hidden from the world. It came from following a disciplined system. The investor researched before buying, diversified risk, invested consistently, ignored short-term market panic, managed emotions, and adjusted the portfolio when necessary. While the exact numbers of this portfolio may be impressive, the habits behind those numbers are what truly changed everything. The exact crypto portfolio that changed everything was not built on luck alone, and it was not created through a guaranteed formula. It was the result of a strategy that balanced opportunity with risk. The investor focused on education, diversification, consistent investing, emotional control, and patience. They understood that cryptocurrency could create extraordinary returns, but it could also create significant losses. The biggest mistake many investors make is focusing only on the final numbers while ignoring the journey behind them. A portfolio that grows dramatically may represent years of learning, surviving market crashes, controlling emotions, and staying committed to a strategy. The numbers may tell the story of the profits, but they do not show the discipline required to achieve them. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.